Dan, very good to see you again. It's a pleasure, as usual, to speak to you. Can you just tell everyone a little bit more about Tristan Capital Partners and your role in the organization, please?
Sure. So Tristan Capital Partners has been in existence as an independent entity since 2009. It operates a range of closed-end opportunity funds. So it's currently investing the sixth in that series fund, which is called the PISA 6. It has a open-ended Core Plus fund. And most recently, and what I'm in charge of, is a lending strategy, which was launched at the beginning of 2021. There's about 15 billion euros of AUM across all those three strategies. We have offices in Paris, Amsterdam, Frankfurt, in addition to London and Luxembourg.
Perfect. And you cover a large number of countries. How do you see the markets at the moment? Which countries are the ones that you think will have the best opportunity, and which ones are you worried about?
It's interesting. It's a very different answer, I think, than what my equity colleagues would give.
Of
Debt
course.
is a quite different asset class, in particular in terms of the type of opportunity that comes to us. So I would say the UK is a very liquid market for alternative lenders such as ourselves, but we increasingly focus on the large continental European countries. So in particular, France, the Benelux region, and probably more so now Germany. So I would say the bigger opportunity that's starting to arise for us is Germany as an opportunity for debt fund lenders such as ourselves, specifically focused on the whole loan strategy. So being a bilateral, effectively senior lender, but offering sometimes a little bit more in terms of either leverage offer than you might get from a bank, or willingness to underwrite more transitional kind of asset business plans. But I would say the sort of emerging opportunity for us is probably Germany and to some degree as well Scandinavia, and that has to do with what's happening in those markets in terms of banking market having to adjust, and as well capital markets not being available for a lot of large investors, in particular in residential, where there are refinancing needs that are starting to arise from bonds coming due, or simply that avenue of sort of capital not being available and investors needing to look to the private markets.
When it comes to your role and doing what you have been doing for the last couple of years, what's the main challenge for you right now? Is it related with the actual transaction? Is it more related with hiring, training, maintaining talents? We were talking about this, these last couple of days.
Yeah.
How do you see that?
Yeah, it's an interesting question. I would say for us, we have a pretty stabilized platform. So I think on the personnel side, we feel pretty comfortable and stable. I would say what we do focus on is, because our product, so because we're a bilateral senior basis lender, whole loan lender, but we're the only sort of lender. It's a relatively simple product, but we've been able to see a large sort of spectrum of deals. The really where we spend all of our time is deciding what we want to work on. So what asset classes, what inside those asset classes, what locations, what types of assets, transitional, stabilized, where do we think the biggest risks are going to arise? So I would say, relative to what we see day one and what we actually transact on, that's a very thin sort of funnel. So we end up at probably less than 1% of what we see we actually do. So that takes a lot of work to kind of sift through, develop the thesis of what where we want exposure on the lending side, and then actually executing on that.
And am I right to assume that you expect the volume of transaction that you take care of will increase in the next 12 months, considering the market situation?
Yeah, and that's because we have become kind of a replacement lender for different emerging sort of holes in capital structures. So we are seeing quite a lot of demand for our products, and as I said, the really challenging aspect is where to focus our time. Where do we think, we recognize that this is a pretty risky moment in the market, but there are still some, aspects, in particular operational fundamentals, which have remained quite resilient. So if we pick our spots, actually the sort of credit risks in the right deals are pretty attractive for what we're being paid.
Is there anything that would keep you up at night nowadays, and why?
What we've seen over the sort of 2.5 years that we've been lending is that the operating fundamentals of European real estate, despite everything you sort of read in the FT and Bloomberg, have been really strong. And everybody's been waiting for the recession to come and for there to be a little bit more pressure on rents, operating assets suffering for, weaker demand. That's probably the thing that we talk about the most, is what's the next leg? Is there a next leg? The effect of, the interest rate hikes over the last 18 months really starting to hit the real economy. That's probably the sort of biggest risk factor that we are debating at the moment.
Thank you very much. Pleasure speaking to you.
Thank you, Gustavo.
Thank you.